On August 12, 1982, Mexico's finance minister, Jesus Silva Herzog, flew to Washington with a message that would shake the global financial system. Mexico could no longer pay its debts. After decades of borrowing and promises of oil-fueled prosperity, Latin America's second-largest economy was broke. This wasn't a missed payment or a technical default. Mexico owed $80 billion to international banks, and the government had literally run out of money. The treasury was empty, foreign reserves were gone, and the next debt payment, due in days, couldn't be made. The announcement triggered the 1980s debt crisis that would devastate Latin America for a decade. Argentina, Brazil, Venezuela, and dozens of other countries followed Mexico into default. Banks that had lent billions faced collapse. The entire international financial system teetered on the edge of meltdown. But Mexico's bankruptcy wasn't an accident or bad luck. It was the inevitable result of a debt trap built by international banks, enabled by corrupt governments, and sold to the Mexican people as the path to prosperity. The country that had nationalized its oil industry and promised wealth for all ended up transferring billions to foreign creditors, while its people descended into poverty. This is the story of how Mexico went from oil boom to financial catastrophe in less than a decade, and why the same trap has caught dozens of countries since. Mexico's disaster began with extraordinary luck. In the mid-1970s, massive oil reserves were discovered in the Bay of Campeche in the Gulf of Mexico, and in the states of Tabasco and Chiapas. Estimates suggested Mexico had 60 to 200 billion barrels of oil, potentially making it one of the world's largest producers. The timing seemed perfect. OPEC had just quadrupled oil prices in 1973. By 1979, a second oil shock drove prices to $40 per barrel. Mexico could sell oil for unprecedented prices, and it had enormous quantities to sell. President José López Portillo declared that Mexico's biggest problem would be managing abundance. Oil revenues would fund education, infrastructure, healthcare, and lift millions out of poverty. Mexico would finally join the ranks of developed nations. The government created ambitious development plans. Pemex, the state oil company, would expand production from 1 million barrels per day to over 4 million. New refineries, pipelines, and ports would be built. The oil wealth would transform Mexico. But developing oil infrastructure is expensive. Drilling offshore platforms costs billions. Building refineries takes years. Expanding production requires massive upfront investment. Mexico didn't have this capital sitting around, so it borrowed. International banks, flush with petrodollars from OPEC nations that had deposited their oil revenues in Western banks, were eager to lend. Mexico had oil, which meant guaranteed future revenue. The loans seemed perfectly safe. Mexican debt grew from $20 billion in 1976 to $80 billion by 1982. But this wasn't concerning to anyone at the time. The oil revenues would easily cover the debt payments. Mexico was borrowing against a certain future of wealth, except that future never arrived. The flood of foreign loans created illusion of prosperity. Money poured into Mexico from American, European, and Japanese banks. Interest rates were relatively low. Terms were generous. Creditors competed to lend to Mexico. The Mexican government spent lavishly. Public sector employment exploded. State-owned enterprises expanded. Subsidies were distributed. The peso was kept artificially strong, making imports cheap and foreign travel affordable for the middle class. Corruption flourished. Government officials and connected businessmen skimmed fortunes from oil revenues and loan proceeds. Capital flight began as wealthy Mexicans moved money to U.S. banks, not trusting their own government's fiscal management. President López Portillo embodied the excess. He built himself a mansion with over 20 bedrooms. Government officials lived like royalty. Public projects were launched not for economic value, but for political patronage. The problem was that much of the borrowed money wasn't invested productively. Instead of building industries that would generate exports and revenue, Mexico spent on consumption and politically motivated projects. The oil infrastructure was developed, but the broader economy remained weak. Mexico also made a critical mistake. It borrowed in dollars, but earned in pesos and oil sales. When oil prices fell or the peso weakened, Mexico's debt burden increased in real terms, while its ability to repay decreased. By 1981, warning signs were everywhere. Oil prices began falling from their 1980 peak. U.S. interest rates rose sharply as Federal Reserve Chairman Paul Volcker fought inflation. This made Mexico's floating rate debt much more expensive to service. Capital flight accelerated as wealthy Mexicans and foreign investors recognized the unsustainability. An estimated $20 billion fled Mexico between 1980 and 1982. The Mexican government tried to stop it through currency controls, but this only increased panic. The debt trap was closing. By mid-1982, Mexico was in crisis. Oil prices had fallen to $32 per barrel from over $40. The U.S. had entered recession, reducing demand for Mexican exports. Interest rates on Mexico's debt had risen, making payments unsustainable. Mexico's foreign currency reserves, needed to make debt payments and pay for imports, were nearly exhausted. The government had been burning through reserves trying to defend the peso and pay obligations. On August 12, Finance Minister Silva Herzog met with U.S. Treasury Secretary Donald Reagan, Federal Reserve Chairman Paul Volcker, and IMF Managing Director Dominique Strauss-Kahn, Director Jacques de Larosière. He delivered the message: Mexico could not make its next debt payment due within days. Without immediate help, Mexico would default. The announcement shocked the financial world. Mexico wasn't some minor country. It was the second largest economy in Latin America and a major oil exporter. And it owed $80 billion to hundreds of banks across the world. The largest exposure was to American banks. Citibank, Bank of America, and Chase Manhattan had lent billions to Mexico. If Mexico defaulted, these banks would face massive losses that could threaten their solvency. The fear of contagion was immediate. If Mexico defaulted, would Brazil, Argentina, and Venezuela follow? The U.S. government scrambled to prevent complete collapse. The Federal Reserve, Treasury, and IMF put together an emergency package of $3.5 billion to prevent immediate default. The money would come from advance purchases of Mexican oil, commodity credit guarantees, and a bridge loan from the bank for international settlements. But this was just a bandage. The real problem was that Mexico owed far more than it could pay. The debt needed to be restructured, and that required negotiations between Mexico, its creditor banks, and the IMF. For ordinary Mexicans, August 1982 marked the beginning of a decade of economic pain. The peso collapsed, inflation soared, living standards plummeted. The promised oil prosperity had turned into disaster. To receive ongoing support and restructure its debt, Mexico had to accept an IMF structural adjustment program. This became the template for dealing with the debt crisis that spread across Latin America. The IMF conditions were brutal. Currency devaluation. The peso was devalued massively, making imports expensive and destroying the purchasing power of Mexican wages. Government spending cuts. Subsidies were eliminated. Public sector employment was slashed. Investment in infrastructure and social programs collapsed. Privatization. State-owned enterprises were sold, often to foreign investors at fire sale prices. Trade liberalization. Mexico had to open its markets to foreign competition, exposing domestic industries to overwhelming pressure. High interest rates. To control inflation and attract foreign capital, interest rates were raised to punishing levels, crushing domestic businesses. The theory was that these adjustments would restore Mexico's economy to health, cut spending, reduce inflation, make the economy competitive, and growth would return. The reality was a decade of stagnation and suffering. Mexican GDP per capita fell by over 10% during the 1980s. Unemployment soared, real wages collapsed by 40 to 50%. Poverty rates exploded. An entire generation saw their living standards destroyed. Meanwhile, Mexico continued paying debt service. Every year, billions flowed from Mexico to foreign banks. The money that should have funded schools, hospitals, and infrastructure instead paid interest to Citibank and Chase Manhattan. This was the debt trap fully sprung. Mexico had borrowed during good times, spent recklessly, and now was forced to squeeze its people to repay foreign creditors. The IMF austerity measures ensured that ordinary Mexicans, who had never benefited much from the borrowed money, paid the full cost of repayment. Mexico's bankruptcy was just the beginning. Within months, the crisis spread across Latin America. In September 1982, Brazil, Latin America's largest economy, announced it couldn't meet debt payments. Brazil owed over $90 billion, even more than Mexico. Argentina, already struggling with the aftermath of the Falklands War, defaulted on its $45 billion debt in 1982. Venezuela, despite being a major oil exporter like Mexico, faced the same problem. Oil revenues weren't enough to cover massive debts accumulated during the boom years. Chile, Peru, Ecuador, Colombia. The crisis spread to nearly every major Latin American country. By 1983, over 40 developing nations were having trouble servicing their debts. The total debt across Latin America exceeded $300 billion. American banks had exposure that exceeded their capital reserves. If these countries actually defaulted, meaning they stopped paying entirely, major American banks would become insolvent. This created a standoff. Latin American countries had the power to default collectively and force banks to write off the loans. But the banks, with IMF and US government support, had the power to cut these countries off from international credit and trade. The outcome was inevitable. The banks had more power. Latin American countries were forced to keep paying, restructuring debts on terms favorable to creditors, accepting IMF conditions, and imposing austerity on their populations. The 1980s became known in Latin America as the Lost Decade. Economic growth was negative or minimal across the region. Poverty increased, infrastructure deteriorated, education and healthcare declined. An entire decade of development was lost to debt service. Meanwhile, the banks that had lent recklessly were rescued. They eventually wrote down some of the loans through the Brady Plan in 1989. But by then, they had collected years of interest payments. The debt that couldn't be repaid had still transferred enormous wealth from Latin America to international creditors. The debt crisis wasn't caused by irresponsible borrowers alone. The international banks that lent to Mexico and Latin America were equally or more responsible. In the 1970s, major banks had huge amounts of capital to lend. OPEC nations had deposited their oil revenues in Western banks. These banks needed to lend this money to earn returns. They identified developing countries, especially oil producers, as prime borrowers. Bank lending to developing countries exploded. From 1970 to 1982, lending to Latin America grew from $29 billion to over $300 billion. This wasn't careful analysis of creditworthiness. This was a lending frenzy. Banks assumed oil prices would stay high forever. They assumed developing countries would keep growing. They assumed that sovereign nations couldn't really default because they'd always need access to credit. All of these assumptions proved wrong. Banks also engaged in aggressive competition. If Citibank offered Mexico a loan, Chase Manhattan would offer better terms to steal the business. This drove down interest rates and loosened conditions, making the loans even riskier. Crucially, banks lent with floating interest rates tied to LIBOR. When U.S. interest rates rose in the early 1980s, the cost of servicing these loans exploded. Countries that had borrowed at 8% suddenly faced rates of 15 or 20%. The banks had transferred interest rate risk entirely to the borrowers. When the crisis hit, banks faced massive losses, but they were rescued by government intervention. The IMF, backed by US and European governments, provided emergency financing to prevent defaults. This was effectively a bailout, taxpayer money ensuring that banks wouldn't lose their investments. Banks also used their political influence to shape the IMF response. The structural adjustment programs prioritized debt repayment over development. Countries were squeezed to ensure banks got paid. Some banks faced consequences. Continental Illinois Bank failed in 1984, partly due to Latin American loan exposure. But most major banks survived and eventually returned to profitability, having learned that reckless lending to sovereigns would be backed by governments. The pattern established in the 1980s continues. Banks lend irresponsibly, crises occur, governments intervene to protect banks, and borrowers pay the cost. Mexico's bankruptcy followed a pattern that has repeated dozens of times across decades. Commodity boom. A country discovers oil, minerals, or experiences high commodity prices. Future revenues look certain. Borrowing binge. International banks lend heavily based on projections of continued high prices. The country borrows for development, but also for consumption and corruption. Bust. Commodity prices fall, or interest rates rise, or both. The debt service becomes unsustainable. Crisis. The country runs out of foreign reserves and cannot make payments. It goes to the IMF for help. Austerity. The IMF imposes conditions that prioritize debt repayment over development. The population suffers while creditors get paid. This exact pattern occurred in Latin America in the 1980s, Mexico, Brazil, Argentina, and others. Russia in 1998. Borrowed heavily, oil prices fell. Defaulted, imposed capital controls. Asian financial crisis, 1997 to 98. Thailand, Indonesia, South Korea borrowed in dollars, faced crisis when currencies collapsed. Argentina, 2001, borrowed heavily in dollars, couldn't sustain peg, defaulted on $100 billion. Greece, 2010, borrowed in euros, couldn't devalue, forced into austerity. Venezuela, 2017 to present. Oil dependent, borrowed heavily. Oil prices fell. Economic collapse. The common thread is that countries borrow in boom times, fail to use the money productively, and then face crisis when conditions change. International creditors lend recklessly during booms and then impose harsh terms during busts. The system is designed to extract wealth from developing countries while protecting creditors. The IMF claims to help countries, but primarily ensures that debts get paid. Austerity measures transfer resources from the poor to international banks. Mexico's bankruptcy in 1982 wasn't an anomaly. It was the standard operating procedure of international finance.